YouTube. Welcome back to the channel, guys. Walter FX gang, good to see you again. At this point, y'all, is day one. Like, this is the fourth video. Mind you, when I say day one, doesn't mean you were here from the first video. You could have come in from the second or third, but the fact that you're still here means you're day one. Never changed up. Welcome back to the channel. Today, I'm going to be teaching you about candlesticks and show you a few candlestick patterns traders use mostly in the markets. Without any further ado, you already know we don't waste time, and let's get right into it. The Japanese candlesticks is basically a price chart that traders use to perform technical analysis. There are also other price charts that traders use. I think the second most famous would be the line graph, but that's not what we're here for today. Most traders don't really use the line graph for technical analysis. They can use it to look at price, to monitor price, but they don't really perform much analysis on them. So the proper price charts most traders feel comfortable with in performing their technical analysis. The most common one is the Japanese candlesticks. The Japanese candlestick was formed in the 1700s by Japanese traders to monitor the price of rice. So, seeing how effective it was, traders developed or adopted that process for their own technical analysis, and so far so good. It has been effective. Now, the candlesticks. How exactly do the candlesticks work? The Japanese candlestick shows you the highs and the lows and the opening and closing points of price. Okay, there are two types of candlesticks. You have the bull candle and the bear candle. The bull candle basically is the buyer's market. It forms when buyers are in charge of the market and they are pushing the price up. So when buyers are in charge and they are pushing price up, price is getting higher, a bull candle is formed. But when price is falling, is a bear market. That's the sellers are in control of the market and the price is going down. And what you will see formed in your Japanese candlestick charts, you'll be seeing bear candles forming. Yes, bear candles for when the market is going in a downwards direction, then bull candle for when the market is going upwards. The buyers are in control. Got it? Got it. Okay, now the candles are formed in time frames, and the time frames go as wide as from 5 seconds to as long as monthly time frames, depending on the platform you're using for your technical analysis. Some platforms might provide you only from, like, let's say a minute to a week time frame. So it's based on you to find which platform best suits your personality, then which time frame best suits your personality. Okay, moving on. How to identify the lows, highs, opening price and closing price of the candle. Okay, let's say we're using the 5 seconds chart. So for every candle in that 5 seconds chart, it opens and closes in 5 seconds. You understand? So the candle points will show you the opening price. That is where the candle started forming, how low the candle went within that 5 seconds, then how high the candle went within that 5 seconds, then what price was on when it closed. You understand? So these highs and lows will be identified by wicks. You'll see a little wick patterns on the body of the candle. So those wick points now shows that, okay, price got that high, but it went down and closed at this point, or price got this low and it came up and closed at this point. Understood? Understood. There are different candlestick patterns that traders use to identify or use to read price action. I'll give you a couple of examples. So you have the hammer candle, then you have the bullish engulfing candle. So now let me explain to you exactly how those candles, or what those candles say. Now the hammer candle is mostly formed during a price trend change. Okay, it's formed when the sellers have been in control of the market, but now at this point they are losing control and the buyers are looking to take over. The hammer candle looks like a hammer. That is, it has a full body on top, then with a wick at the bottom. Remember what I told you a wick is? A wick will show you the highest and lowest points price got. Then the body, the opening and the closing price. So the hammer candle normally has the body at the top and a long wick underneath it. This shows that the sellers are losing strength in the market and it's time for the buyers to take over. It's a very, 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 very efficient chart pattern that shows that, okay, a buy market is about to start, especially if it's followed by a large bullish candle. If you see a hammer candle followed by a large bullish candle, it is a very good signal that, okay, the buyers have taken control of the market. Secondly, you have the bullish engulfing candle. The bullish engulfing candle is formed after a bear candle just formed, then a long bullish candle, which is bigger than the previous bear candle that just formed, forms right after it. It shows that, okay, the buyers have charged in, they have taken control, they have just overpowered the sellers. So the market is most likely to go upwards. So most buyers use this to read support and resistance zones. A support is basically when price gets to a point, price sells to a point that it cannot sell anymore. It will normally bounce off of that point when you look at price history. Like if you go back to the previous chart, you see when price goes to this point, it mostly bounced off of it. It's like, okay, let me just use this to explain support and resistance to you. You bounce a ball in your room where you have a floor and a ceiling. The floor is the support and the ceiling is the resistance. So when you bounce the ball on the floor hard, it will go up, hit the ceiling, and come back down to the floor. So normally price will bounce between the support and the resistance. The support is the floor, the ground level. Then the resistance is at the top. So if price is selling, is going down, and it reaches the support, that's now when using like a ball. You bounce the ball, it hits the support. It will bounce back, go, test the resistance, and bounce off the resistance, and come back to the support. You understand it, back and forth. So that's one strategy most traders use in running their analysis. But then again, there are other strategies you can work with, but I'm just teaching you the most common one. Later in the future, I'll show you my own personal strategy that I use and other strategies that you can adopt. That's it for today's video. If you made it this far, like the video, leave a comment. You can ask me anything you want or just thank me for the class. See you next time, Walter FX Gang. Can't wait.